Hey guys, what's up and welcome back. I know it's been a little while since I've uploaded a video, but I took a little break and now I'm here back gonna make consistent videos. So in today we've got a two-piece. We've got the economy has proven it can live with 4.5 to 5% bond yields. That's a big statement. And our second one, there will be a very meaningful repricing in corporate credit risk. So hope you guys enjoyed the video as always. I hope everybody's doing all right. You know, we've got earnings coming up pretty soon, starting this week. And we've got some big things happening in some other countries that are not so fortunate. So, as always, I hope everybody's doing all right. Let's jump into these videos.
Earnings season picking up steam this week with more than 50 S&P 500 companies and 5 Dow components set to report results. Joining us right now is Ed Yardeni. He's the president of Yardeni Research. How are you setting yourself up this morning, or maybe even I should have said last week, ahead of everything we've already started to hear on Friday?
Well, to tell you the truth, after hearing that report that we all just heard from the Middle East, things look just basically horrible over there. Yet, you know, the market's hanging in there pretty well, and I think that's because we've had several of these crises and conflicts between Israel and Hamas that led to ceasefires pretty quickly. This one looks like it's going to linger. And yet the price of oil hasn't really shot up. But I'm accentuating the positives here in terms of what the market's focusing on. And that's, as you said, it's earnings. I think it's very likely that when all the earnings come in, that the third quarter is going to be at an all-time record high for S&P 500 earnings, which is pretty impressive all in all, since the Godot recession, the most widely anticipated recession of all time, just has been a no-show so far.
So, Ed, though,
Man, with all this going on, the market is up high. Most of the mega caps are near or at all-time highs. But to think that the S&P is going to be at all-time highs and is just from this earnings season, amidst all of this impact rate hikes that we're still feeling, a big conflict just broke out. I mean, we've already got enough negatives to go, and we're still adding negatives. And at this point, the market's still going up. It is being quite resilient. So I guess that's where he's coming from for the 4.5 to 5%, which is quite different from the last 13 years.
Think about how do you think about those earnings? And I know it's just impossible to put these things together with what's happening in the Middle East and what you think the larger geopolitical implications are, and therefore for the broader market. So we could have amazing earnings, but it's not even just what's happening now. Obviously, stock prices are looking out, call it 12 months, 18 months out. You know, where are we then? And how does this situation factor in? Recognizing, interestingly, at least from the academic studies that I've seen, and just, you know, you look at charts over the years, you know, with the exception of what was taking place.
We're at such an inflection point. That's probably the hardest call to make in the last, 10 years. Where are we going to be in the next 12 to 18 months? I mean, if the market starts from here and just goes down and down and down and down like it's gone, I mean, we could be crazy far down. And if the market just keeps ignoring everything and we just keep bracing everything and factoring everything in, we could be at all-time highs. So it's honestly, I can't even guess anymore. I have no idea what's going on. Long-term bulls, it's even hard to be a long-term bull when you're trying to put new money to work. Is this going to be a good price? Is this going to be the top? Who knows anymore?
In Israel in 1973, for the most part, when there have been problems in the Middle East, they have not impacted the stock market as negatively as you might imagine they would.
Correct. Well, I think the obvious example of when the Middle East really did have a tremendous impact on the global economy and certainly on the stock market was back in the 70s, when we had 2 energy shocks in 1973, and that was related to a war between Israel and the Arab states. And then in 1979, when the Iran Revolution occurred, oil prices soared a lot more than they've increased so far since the summer. And as a result, I think the market is looking over the next 12 months and concluding that this too shall pass. One way or another, the situation will be stabilized. And if that's the case, then the outlook for 2024 is probably pretty good.
Okay, but here's the thing, you know, prior to a week and a half ago, where was it a different debate about not whether things, putting what was happening in Israel aside, because it hadn't happened yet, there was just a fundamental debate.
It's so interesting. 1 week they have the entire basket and wagon full of reasons why the economy can't go higher, and this is tapped out, and we have to start feeling all these rates and every single thing they can think of in a matter of days, sometimes hours, sometimes weeks. It's the entire narrative for every single person that'll be on CNBC is all of a sudden will be positive.
About whether we were headed towards a recession, how
Correct.
deep the recession would be, and whether, frankly, 2024 or 2025 actually wasn't that it was going to be positive or stable, it was going to be bad. I mean, that was, I think there was a lot of people that were concerned about that.
Sure. Well, look, one of these days a recession is going to happen. The business cycle hasn't been, forever banned. And I do think that the outlook for now is pretty good. I mean, the economy has proven to be remarkably resilient. It's true that we've seen this tremendous increase in short-term rates and the bond yield, and yet the consumer continues to spend. There's still a lot of fiscal policy stimulus in the pipelines. Companies are investing in artificial intelligence and so on. And as you know, we had a really strong GDP during the third quarter, which is why earnings are probably going to be at a record high. So I think the economy has proven that it can actually live with 4.5% to 5% bond yields. Obviously, if we go a lot higher than that, Jamie Dimon of JPMorgan.
And obviously the Fed's calling for 2 to 3. They're not calling for 3 yet, but most people think they're going to have to give up from 2% that they're calling for to 3. They seem pretty steady at 2. He said we can make it at 4.5 to 5. We'll see where it shakes out.
Morgan has been saying, these are extremely dangerous times, and yet his bank reported tremendous upside surprise earnings in the third quarter.
Hi, Lou Villiers.
All right, guys. So as you can tell, there's always so much news back and forth, back and forth. Some people say that we can make it with these higher interest rates. We proved to have been making them so far. The counter argument for why we have made it so far is that it takes longer, the Fed lags, and that it takes longer to start feeling these rates, and we're in for a bad 2024 because we're just getting to it. The other argument is that it's been hitting, and we obviously the stock market can't be stopped. It's factoring in everything, and it's factored in that quick, and it can't be stopped. I'm in the first camp. Even though I'm a long-term bull, I think this stuff takes a little bit longer, and the Fed lags are starting to catch up. We'll see. I'm praying for a 2024, happy 24. It doesn't matter to me. I'll make money, and if it goes down, we'll buy at better prices. Now we're jumping into there will be a meaningful repricing in corporate credit risk, says JPMorgan's Oksana Aronov. Okay, she's got a hard name. We're just going to hear what she has to say.
For more on the markets is Oksana Aronov, who is head of market strategy and alternative fixed income at JPMorgan Asset Management. And welcome. Thanks for coming in today.
Thank you.
Let's talk about the economy and what that means for rates, because that has to be driving every decision that you're making for investors right now when it comes to fixed income.
Absolutely, and it's really fascinating to me. We had, just a year ago, we were pushing 490 on the 10-year. We had a monster job beat. We had a couple of weak Treasury auctions. We had a beat on the PPI. We had a beat on the CPI. And yet we've seen a rally in Treasuries while risk sectors like equities, like credit risk, have actually continued to move up unabated, even on the events in the Middle East. We're seeing the Treasury rally give up some this morning, but really this is about the push and pull, right, between the geopolitical risks and the strength, the continued strength of the U.S. economy, as well as continued technical challenges to the bond story, to the rate story, and the fact that there are larger Treasury auctions. The Treasury is trying to finance tremendous deficits at a time when the largest sources of demand are stepping back.
Yeah, let's talk about that last part first. Just the massive deficits the Treasuries need to get more and more money, bringing more Treasuries into the market. I think last week's auction was maybe a little surprising with some of the stuff that went, especially with the 30-year. What do you hear from clients? Do they raise these same questions about concerns about, hey, what's going on with the deficits, and do we really want to be buyers at these levels, or we'll hold out for higher?
I think
Before what she has to say, I will give my opinion. I will say, I've been, as somebody who's trying to be a buyer of some of the mega caps, it is incredibly difficult. You can't just take into consider PE ratios or earnings or what's going to happen. You have to take in so much more into consideration. And we're in between these levels to where we can still fall back to the lows that we've had in 2022, and we can still fall, and we can still very much get way past the highs. So it's kind of a crazy market. You have to, if you're going to get in, you have to be able to risk a pretty meaningful percentage. And but the other risk is that you can get in, or the other options are that you can get into stocks that have been beaten down. I recently bought some Nike at $90 a share. $90 a share. Go look at the stock price of Nike. Look how I made out and how that's going to be over the next few years. So there are opportunities in this market. You do have to find them. I do think the mega cap 7 are still going to lead. They will still lead for the next 10 years, in my opinion. So we might have to start paying up a little bit more as far as PE ratio goes. Let's see.
Definitely those questions are coming through. They're coming through in the fact that that long end of the curve has been pushed up so significantly. The Fed has only raised 25 basis points since May, and yet we've seen this tremendous push up in the long end of the curve. So finally, right, the bond market is noticing the sort of financial underpinnings. The fact that, of course, the Fed has not been able to get services inflation under control, and now we're possibly seeing a reigniting of inflation because of, oil and some commodities, some other pressures. So we'll see how that plays out. But certainly the technical picture is an important one. We have, something like 30% of outstanding treasuries maturing over the next year and a half. You have the Fed selling $1 trillion of treasuries. You have the largest foreign buyers. China has been lightening their treasury load by about $300 billion a year since 2021. You have banks that are not net consumers of
China, and I think, if I'm not mistaken, a couple other places have been offloading their U.S. debt at a record pace, which is not before seen.
Treasuries, right? And all of this is happening as the Treasury is trying to finance $1.5 trillion of deficit spending. So, and when you kind of pick up your eyes and look out over the horizon, right, in terms of secular trends, we're likely going to continue to see more pressures with respect to inflation, because whether you look at demographics, whether you look at some of the green energy initiatives, right, all of those things, the populist trend generally, globally, all of those things are inflationary in the long term.
At least there's got to be a floor that's underneath treasuries when it comes to the yields on some of these issues. Lee Cooperman told us last week at a CNBC conference that he wouldn't be touching the longer term bonds below 5.5%, because he just thinks the trend is only up from here.
It makes a lot of sense, because historically the 10-year has really been the sum of growth, inflation, and a long-term premium of some sort. And when we just simply look at growth and inflation, right, that should bring us over 5%, and we're not there. And I've been saying that, look, the 10-year is still, even at some of its peak levels a couple of weeks ago, is still very much priced for a 2% inflation world. And if inflation does settle closer to 3%, then that will absolutely mean a repricing at that end of the curve.
So is that where Jamie Dimon gets some of the comments he makes about this, where he thinks, look, not that we're necessarily headed to 7%, but it wouldn't shock him? I think businesses should be prepared for it.
I think we're in agreement with that statement. Yeah, I certainly can't speak for Jamie, but I think generally we're in agreement that technical pressures, longer-term secular pressures with respect to inflation, and the fact that I think the Fed is just generally, I think Jay Powell is generally content to sort of demolish this really unhealthy relationship between asset prices, right, and Fed policy. And I think investors waiting for the Fed punch bowl to come back in the event of a slowdown will be wholly disappointed. So
that's true. Anybody out there waiting for some more stimmy checks, go ahead and let your breath out, because you're not getting any more. Not to mention that, so we have one person saying we're going to have a great 2024. We're taking in all this at face value, and we've already priced it in. We have the other one giving pure examples and trillions of dollars that have to move around against us, especially as stock market holders. We have people still calling for 7 to, I think somebody called for like as high as 13% yield rates or something just astronomical. And it's going to break the system, guys. So hopefully 5% ends up being a big number, because if we start getting to numbers that make 5% look small, we are in trouble everywhere, the whole economy and the stocks.
Unless we see the economy in some kind of a free fall, yes, central banks will probably get re-involved. But a garden variety slowdown is not going to
They're not coming to the rescue.
No.
So what do you tell investors to do right now? How that's completely changed the paradigm of what we've gotten used to in the last 15 years or so.
Absolutely. So what we've been saying is that the next 10 years are going to be nothing like the last 10. There's going to be a lot more volatility to bonds. We're seeing it in the MOVE index, which is settling where we used to live pre-GFC. It feels like bond volatility is elevated, but really it is exactly where it used to live before the great financial crisis. And so we're saying, look, you have to preserve optionality in the form of liquidity because it is paying you, but you absolutely have to attack opportunities as they arise, whether they're related to the banking sector earlier this year, whether they're related to commercial real estate as this year continues to move along. And one area where we think there'll be a very meaningful repricing is corporate credit risk, right? We saw the Rite Aid default this morning. Even before that, this year was already in the top, 5-6 years of defaults, and we're still, 3 months away roughly
So it's
from
not
the end
it's
of the
not
year.
pricing it in yet.
Absolutely not. Credit spreads are wildly optimistic about the default prospects. We've tripled defaults since the start of the year, albeit from very, very low levels. But the default cycle is underway, and we're going to continue to hear the drumbeat. So there's going to be some really interesting opportunities to get involved. And right now, you can sort of clip that coupon at the front end of the curve, but certainly there are things to do for.
So she's calling for, look, just get your money ready. Go ahead and start building up a pile of money. You don't even need to start buying right now. You are almost guaranteed to get lower prices, is what this lady is saying. That sounds very scary. You couple that with, I know what the last 10 years look like, and these next 10 are not going to be anything like that. That is quite the statement, and I'm sure she has more than enough info to back it up. The economy is in a very, very tricky state right now, and we've been through things that are just as tricky. We've been through things that are even harder. We will see if America will persevere again. I bet that they do, and I bet we get better prices. The best thing I think we can do is just keep putting money in a consistent basis, guys. As always, I hope you enjoyed the video. If you did, hit the like button. Thanks for being subscribed, and I will catch you in the next one, guys. I'm here back. No more break. Love you.